Welcome to the deep dive. We unpack complex topics, aiming to give you the essential insights. Today, we're diving into something really crucial and honestly often misunderstood for a lot of you. U.S. individual estimated tax payments. We're focusing on partners in pass-through entities and, other high-income earners, specifically looking ahead to the 2025 tax year. Our mission today, cut through the jargon, pull out the key nuggets, give you stuff you can actually use to manage your federal taxes, avoid those penalties, and importantly, optimize your cash flow.
Yeah, and what's really fascinating here is just how connected your personal tax situation is with the business itself. It's intricate. So we'll walk through the basic rules, how that partnership income actually gets to you tax-wise, and touch on some surprising strategies, ways to potentially keep more of what you earn.
Okay, let's get into it. This whole pay-as-you-go system, I think a lot of people figure, hey, I got a refund, I'm good, right? But you mentioned something earlier that caught my ear. You could still face an underpayment penalty even if you get a refund later. How does that work?
Exactly. That's a common misconception. The IRS, well, they want their money consistently throughout the year, not just in one lump sum. And for high-income earners specifically, if your adjusted gross income, your AGI, was over $150,000, the prior year, there's this key safe harbor rule. Basically, you've got to pay in at least 110% of what your tax liability was last year. Pay that much through withholdings or estimated payments, and you generally avoid penalties.
110% of the prior year's tax. Okay.
Right. It's simple, but here's the catch. Just hitting that 110% mark, it's often not the best move for your actual cash flow. You might be overpaying significantly during the year.
That makes sense. You're paying based on last year, not necessarily what's happening this year. So what does this mean for partners in, say, a partnership? I've heard this term, phantom income. What's that about?
Phantom income. That's a really important concept for partners. It raises this key issue. You can be taxed on your full share of the partnership's income, even if the partnership didn't actually distribute all that cash to you.
Wow. Okay, so the money's on paper for tax purposes, but not in your bank account.
Precisely. That can be a huge shock if you're not ready for it. Your Schedule K-1, that form you get from the partnership, it's absolutely critical. Don't just look at the final number. It breaks down types of income. You got ordinary business income, maybe separately stated items like capital gains or qualified dividends, and they're all taxed differently.
Okay, so understanding the K-1 details is vital. And isn't this tied to something called basis? You mentioned that earlier. It sounds kind of like a limiter.
You got it. Think of your outside basis as like your personal investment tracker for that partnership for tax purposes. You absolutely have to track it. Why? Because it dictates two main things. How much partnership loss, if any, you can actually deduct on your personal return. And whether any cash distributions you do receive are tax-free returns of your investment, or if they become taxable income.
So it controls deductions and distribution taxability.
Exactly. And interestingly, things like your share of the partnership's debt, that can actually increase your basis, which might let you deduct larger losses. It gets complex, but it's fundamental.
Okay, fundamentals covered. Now let's talk strategy. This is where it gets interesting. Finding ways to legally save some money. One big one that's been huge for partners, especially in certain states, is the SALT cap workaround. What's the deal there?
Right, the SALT deduction cap, big topic. So federally, your deduction for state and local taxes, that's DAHALTE, is capped at $10,000 per household.
Which is, frankly, pretty low for high-income earners in high-tax states.
Definitely. But here's the workaround. Over 36 states now have an elective pass-through entity tax, or PTE. What this lets the partnership do is choose to pay the state income tax at the entity level on behalf of its partners.
So the business pays the tax, not the individual directly.
Exactly. And because the partnership pays it, it becomes a federal business expense deduction for the partnership. Fully deductible, no $10,000 limit.
So it effectively bypasses that individual SALT cap. That's clever.
It's a huge benefit, converting what would have been a limited itemized deduction for you into a full, above-the-line business deduction for the entity. We should mention, though, the future of PTT laws is a bit uncertain, especially with potential tax law changes after 2025. Something to watch.
Good point. Okay, shifting gears slightly. Retirement accounts. Always important for wealth building. What about things like the mega backdoor Roth? Is that relevant here?
Oh, absolutely. Maximizing retirement savings is key. The mega backdoor Roth IRA strategy is powerful for high-income earners. See, if your income is too high, you can't contribute directly to a Roth IRA. But if your 401k plan at work allows for after-tax contributions.
Okay, that's the key requirement. The plan has to allow it.
Right. If it does, you can contribute additional funds on an after-tax basis, up to the overall 401k limit, which is pushing $70,000 for 2025, including employer match and everything, then you can often convert those after-tax contributions into a Roth 401k or roll them over to a Roth IRA. Boom, tax-free growth from then on.
Wow, potentially moving significant amounts into a tax-free growth environment. Powerful stuff. All right, one last crucial point before we wrap up. Your individual tax return, as a partner, it really depends on the partnership's own tax return, right? They're linked.
Inextricably linked. You need transparency there. Your K-1 comes from the partnership's Form 1065. If the partnership's return has issues, maybe big differences between their books and their tax reporting, shown on Schedule M1 or M3, or say their balance sheet doesn't balance, or your K-1 somehow shows a negative basis calculation.
Correct.
Major red flags. Those signal potential problems, maybe even audit risks that could flow through directly to you. So it pays to understand or have an advisor who understands the partnership's overall filing. Don't just blindly accept that K-1.
That's a really critical final point. Okay, so wrapping this up, what's the big picture for our listeners? It seems clear that managing estimated taxes, especially as a high-income earner or partner, isn't just a quick calculation you do once a year. It's ongoing.
Absolutely. It's a dynamic process. It requires paying attention throughout the year. The real key takeaway, though, is to think beyond just barely avoiding penalties. The goal should be more strategic. It's about wealth preservation, cash flow optimization. By really digging into your K-1 details, tracking that basis carefully, and actively looking at these advanced strategies like PTET, if it applies, or maybe Roth conversions, you turn tax compliance from just a chore into, well, a powerful financial tool.
It really does highlight how many different levers you can potentially pull. It's not just one simple thing, makes you think, too. As the tax rules inevitably keep changing, what other hidden opportunities or maybe challenges might pop up? And how are you going to stay ahead of that curve? Definitely something to chew on until our next deep dive.